This is your investment update for June 2016. June ended up being quite an interesting month because of Brexit. Just to recap, the S&P 500 ended up around 25 basis points, so U.S. markets didn't do a lot. Internationally, the developed international markets were down over 3%. They had a really rocky couple of days after Brexit. Bonds were really the source of most of the return this month. Domestic and international bonds were up huge and kind of a flight to safety. We'll spend most of this time talking about Brexit since it's kind of important. So on June 23rd, the UK voted in its referendum vote to leave the EU, which the European Union's 28 member countries, and the UK voted by a 52% margin to leave. So this is important. The markets freaked out. They were down a lot the next couple of days, and then they've stabilized since. The second and third order effects of this are what's important. So what the Brexit means is the UK is going to leave the EU. So that's going to take 2 years. They have to pass a bunch of articles through Parliament, and they have to go through just a mountain of red tape. They have to redo every trade agreement they have. They have to redo everything all the way down to immigration with all these different countries. So you can just imagine the level of government stuff that has to go on, and red tape and lawyers. It just takes a long time. This is going to be something we're going to be hearing about for a couple of years, and it's just not going to be a quick, short-term problem that's going to all of a sudden flare up and Britain's going to be the center of the next crisis or anything. That's not the issue. The issue is what happens down the road. And you've got two important issues. One, UK is going to become the poster child for the European Union. If they have a really kind of gentle or easy exit, what's going to happen when these other countries that are in trouble look at it and say, oh, we'd like to leave too, and they do the same thing. And then all of a sudden you have not only a European Union that's in crisis, but you have a currency that may no longer be viewed as viable, which is a huge problem. The flip side of that is the EU may use this opportunity to take the hard line and make conditions so onerous on the UK that nobody else will ever think about leaving. That's actually what I think will probably happen. So that'll be a whole, just kind of a can of worms that's going to be going on for a while. The real issues lie in the fact that, as we've talked about, central banks have transferred all the risks into the currency markets through quantitative easing programs and printing money and manipulating their own markets. And the currency markets are basically a large vote of confidence. That's how they trade. It's how confident are you that the US dollar is worth $1? And they're very esoteric. The average investor really doesn't understand how they move. So anytime anything weird happens there, volatility really spikes because there's a lot of uncertainty surrounding them. And what you have now is you have China trying to devalue in an orderly fashion, which we've talked about in previous videos. Any disruption of that, a strong US dollar, the euro acting weird, that screws up their plans and their markets could get bad. European Union was already facing deflation in the periphery of Europe, and they've been fighting that through aggressive quantitative easing. They're buying all their bonds issuance over there, and now you have to deal with a disruption in what they're trying to do. Japan's trying to keep Abenomics alive. The yen's getting stronger, which is not what they want, and the US dollar has gotten really strong, and you have oil heading south now, and that's all because of Brexit. Brexit kind of threw a rock into the pond, and now you're seeing the ripples spread out. And what this just tells you is that risk globally is still there. It's actually worse than it was a couple months ago, and you have to be very careful and take measured risk when you're investing. This isn't the time to be indexing and just acting like we're going to get double-digit returns. These are very volatile times. You have an Italian banking crisis that's been very quiet, that's about to not be very quiet. And so you just have all these little things that can disrupt the currency markets, which, like I said before, can become very volatile, can erase gains really fast, can also cause the market to just shoot higher all of a sudden if things settle down. So this is going to be a time to take measured risks, be patient, and wait for opportunities to arise.